The utilities sector has significantly underperformed the S&P 500 ever since the beginning of 2023. However, in recent weeks, the utility sector has surged ahead and has outperformed the S&P 500 and has begun to claw back some of that underperformance over the past year and a half. In this video, we're going to discuss why it underperformed, why it has recently been outperforming, and why we think that outperformance is likely to continue moving forward. Hey everyone, this is Samuel. Before I get into today's video, if you could please give this video a like, I would really appreciate it. Thank you very much. Okay, so why have utilities been underperforming the S&P 500 for the past year and a half, 20 months or so? Well, the biggest reason is simply because interest rates rose significantly, really ever since the beginning of 2022 as inflation soared and the Fed hiked rates. And even in 2023, we had some bouts where long-term interest rates are going higher and the Fed was holding interest rates at an elevated level. It looked like we were going to have inflation and interest rates higher for longer. And so utilities underperformed in that environment. And the biggest reason why is because they're viewed as bond proxies. And as bond proxies, due to their regulated cash flows, or in some cases related to them, long-term contracted cash flows, like for example, renewable assets, you have power purchase agreements, or pipelines, you may have long-term cash flows through contracts, but many of their assets are also regulated. So regardless, these are very stable cash flow investments, and so they're similar to bonds. And so a lot of investors look at them as bond substitutes for their high dividend yields, for their stable cash flow yields. And so when you have interest rates rising, the relative value of those cash flows goes down. And so as bond yields rise, investors expect the earnings yield and the dividend yields of utilities and related investments to rise accordingly. Another reason why higher interest rates hurt utilities is simply because they're capital-intensive businesses. It takes a lot of capital to build pipelines, to build transmission lines, to build power generation centers, etc. And so as the cost of capital rose with rising interest rates and falling stock prices, the cost to grow went up. And so a lot of these utilities had to reduce their growth investments, and therefore their lower growth meant that they were less attractive overall investments. Another big reason why utilities underperform the S&P 500, and I actually think there's somewhat of a market disconnect here, and it's beginning to unwind, and I think it will continue doing so moving forward, is simply because the AI boom really took off in early 2023 with the advent of ChatGPT, generative AI. You had companies like NVIDIA posting these blowout quarters and guidance due to the demand for their chip technology that is sparking the AI boom. And so many investors were rushing into these mega cap stocks like NVIDIA, Apple, Microsoft, etc. to try to chase the AI boom. And that sent the S&P 500 higher because those mega cap tech stocks dominate the market cap of the S&P 500. Meanwhile, utilities were left behind. However, I think this is going to change moving forward. And that really leads me to the next section of my video. But before I get into that, if you're enjoying this video, if you could please subscribe to my channel so you could get future content like this, I'd be greatly appreciative. And so why do we think that the outperformance of utilities has recently come to the forefront and is likely to continue moving forward? Well, the biggest reason is simply that the market is now pricing in Federal Reserve rate cuts starting this month already here in September and likely to continue through the end of the year and even into next year. And the biggest reasons for that are, one, inflation has been steadily coming down. There were some fears about a resurgence in inflation earlier this year, but now it appears that that was not the case. Inflation is at least peaked and is likely continuing to trend down towards the Federal Reserve's target rate of about 2%. It may take a while to get there, but as long as inflation remains on course to get there, the Fed can start to ratchet down its federal funds rate because it's currently at a restrictive level. And so even if they just bring it down gradually, it'll still be somewhat restrictive and keep guiding the economy towards that 2% inflation target without actually throwing it into recession if they can cut rates at the right rate. So who knows if they'll do that correctly, but regardless, lower interest rates are likely going to mean, for the reasons we already mentioned, that a bond proxy and a capital-intensive business model like utilities are going to benefit significantly. Another reason why, though, is also just due to the fact that utilities are viewed as a very defensive investment. And so as concerns about growing risk of recession rise, for example, unemployment is now up 4.3%, which is a 20 basis points increase just over the last month before that. So that's raising concerns. It's up about 50 basis points over the past 12 months low level of unemployment. And so those are indicators that could be predicting that we could be headed for a recession. Goldman Sachs recently increased its percentage percentage chance of a recession coming. Some previous jobs numbers were dramatically revised lower, so that also indicates there could be recession risk. Credit card debt is at record levels in the United States. Consumer confidence, consumer spending is declining. Consumer savings from COVID have been completely wiped out. You've got continued economic stagnation in Europe, Japan, and China. And so you also have the decoupling going on between many Western countries, including the United States and China. And so all those factors are headwinds for the economy. That's not even to mention if we were to have a geopolitical flare-up in East Asia or the Middle East, that would put a further weight on the economy. And so all of that's combining to paint this picture that at the very least we're likely going to experience an economic slowdown, potentially a recession. And so all those things make utilities, which are a very defensive investment. They provide essential services, whether it be water, electricity, natural gas, etc. Utilities are now being viewed as more attractive investment on a risk-adjusted basis. So that's also causing some capital to enter into utilities. And so I think another big reason that's probably not being fully appreciated yet, and I think there's additional room to run on this as well, is the AI boom. So obviously the mega cap stocks, they're the ones making a lot of money right now, like Nvidia, for example, from the AI boom. And many are speculating that, Microsoft, Amazon, Apple, Meta, et cetera, those are all going to be major AI players as well. And they're making big investments and big bets on AI. And so they've also gotten a nice bump there. But I think utilities are going to be big money makers as well, because to run these data centers, to run these AI applications, it's going to take an enormous amount of electricity. And so that's going to provide infrastructure companies, whether it be renewable power generators like Brookfield Renewable Partners, which just recently signed this massive deal with Microsoft to help fuel their AI investments with renewable power, or a lot of these pipeline companies like Kinder Morgan or TC Energy that are expecting to also profit from AI boom investments, or even some of these power generators like Vistra Corporation that have also seen their stock prices soar on expectations for this AI boom. But even just everyday utilities that are in regions that are somewhat close to where data centers may get built, they're also going to see tremendous demand for them to increase their electric generation. And so there's going to be huge growth opportunities across the utilities and energy infrastructure space that should cause a boom. And I don't think that's been even close to fully priced in yet, especially compared to the amount of bullishness on AI that's been priced into the mega cap stocks. So I think that's a third reason, so when you combine declining interest rates, which obviously benefited on a comparative basis to bonds, as well as the idea that growth should be cheaper for them, lower cost of capital, fears over a recession, even geopolitical risk, which make low risk essential services, contracted or regulated business models like utilities and energy infrastructure companies also more attractive. And also the AI boom, which I don't think has been fully priced in yet into the utilities and infrastructure space relative to the mega cap stocks. I think those are three big reasons why you can expect utilities to outperform moving forward. Now, finally, how should you invest in utilities to profit from this? Well, there are many ways to do it. I think one of the most common ones is just invest in a low-cost ETF, like ticker symbol XLU. It's got a very low expense ratio. It's got a solid dividend yield. It's got a lot of big blue chips in the portfolio, well-diversified, good liquidity. You get nice dividend growth combined with a decent dividend yield that's going to be about twice as what you'd get from the S&P 500. So that's one way to do it. Not a bad approach, nice and easy, low cost. Another way to do it is invest in a leveraged CEF like UTG. It's a popular one. UTF is another one you can invest in as well. They're similar. I'll link to a video I did comparing them in the past. And share with me in the comments below which one you like more at the moment. But UTG one is a little more concentrated in utilities, so we'll discuss that here. They have a relatively low expense ratio for an actively managed CEF. CEFs typically have very high expense ratios. UTGs is actually below 1% if you're just looking at the management fees. Now, when you factor in the interest expense from their debt, yeah, it's over 2%. But that interest expense is still, it's going towards something because you're using it, the leverage to buy securities that pay dividends. And so it's not like an apples to apples with a regular expense ratio. So I would just focus on the expense ratio of actual management fees and compare it to a fund like XLU. While UTGs and UTF both certainly have higher expense ratios than XLU, you do get the benefit of leverage and you get the benefit of active management. They pay out very attractive dividends. UTG at the moment is paying out an over 7% dividend yield. They distribute that monthly. Obviously, the 7.2% is on an annualized basis, not a monthly basis, but you do get a monthly dividend check. It's proven to be remarkably resilient. The management has been very committed to paying out that distribution, so should be fairly sustainable. Again, well-diversified portfolio. I like that UTG does not use that much leverage. It's under 20% right now. So even if we were to go through a market crash where utilities got hit, I think UTG would hold up better than some of these other heavily leveraged CEFs. And so there's an aspect that there's safety that comes with it. And UTG is not particularly expensive. It's not really that cheap either at the moment. It's trading roughly in line with its NAV, very slight premium to it, and roughly in line with its historical average. So I think UTG is a solid way to play it. You get a little bit of leverage, you get a higher yield relative to XLU. Yes, you have a higher expense ratio and a little bit more risk, but if you're really bullish on utilities and you want that higher yield, UTG is one good way to go. Personally, I like buying individual stocks the most. I think that's the most effective way to invest in any sector, especially if you know what you're doing. Now, if you don't know what you're doing, you just want instant diversification, I think that's where funds come into play, or you just don't want to deal with research. But because I like to do research, I manage my own portfolio actively, I think individual stocks are the best way to do it. I think one of the best opportunities is Brookfield Infrastructure Partners. It's a diversified infrastructure fund, but they do invest a lot in utilities. In fact, management describes themselves as a growtility, a growth-tility. And what that means is they invest in utility and utility-like assets, and they employ an aggressive growth strategy that has delivered market-crushing returns since inception for BIP. It's got very impressive dividend growth along with an attractive dividend yield of about 5% at the moment. They're invested in, obviously, utilities, midstream, which is utility-like in nature due to the contracted and regulated nature of those cash flows. They invest in a lot of transportation assets, which are also utility-like, like toll roads, which generate very stable cash flows, or leased containers on ships, railroads, etc. So again, those are very essential type services that they provide that are fairly recession resistant and have long dated cash flows that are attached to them. And so again, very profitable. Then finally, they invest in a data segment, which is their fastest growing. They have some towers in there, which are also utility-like with their long-term contracted natures. But then they also have data centers that they're investing in. And these are going to profit significantly from the AI boom. In fact, management expects to generate over 20% IRRs on these investments in their data centers that have high growth prospects and really is a leveraged bet on the AI boom. So I think BIP is, when you combine their expected FFO per unit CAGR of over 10% moving forward, their 5% current yield, their expected distribution growth rate of likely between 6 and 8%, but the official range is 5 to 9 moving forward. That's been backed by their own track record of doing that for years. You get a good equation for mid to high double teens annualized total returns. You get good exposure to the AI boom while also getting the safety of utilities and utility-like instruments. You're going to benefit from trends like falling interest rates, falling cost of capital, AI boom, and you're still going to be fairly defensively positioned against a recession. You also have a very strong balance sheet with a BBB plus credit rating, very good liquidity, well-laddered debt maturities, very little debt at the corporate level relative to the asset level, so reducing corporate level risk. And you're backed by one of the world's largest alternative asset managers in Brookfield. So that's why I like BIP so much as a way to play on the utility space. I'd rather do that than UTG or XLU personally. But again, to each their own, depending on your risk levels and your goals, etc. But anyway, I hope this video was helpful for you. If it was, again, please give this video a like, subscribe to my channel, comment below what your thoughts are on the utility space and what some of your favorite plays are at the moment. Thank you very much. See you next time.